Recording in.
Okay, so we'll start the session. Hello, welcome all. This is Dave. Welcome to GuruSchools. As a part of our giving the domain knowledge every Tuesday and Thursday, we discuss at 2 o'clock Eastern Time different topics, which helps us to get a better understanding on the functional knowledge of a particular industry. So last week we had Anil Agarwal. Is a dear friend, and he's a serial entrepreneur in few businesses. So basically, I simply reached out to him and I said, can you share your wisdom to our employees who will benefit in terms of preparing for their interview as well as the functional domain knowledge. So last week, he gave some knowledge. It was a little heavy dose on life insurance and all. Today, he will discuss more on home mortgage. Okay, so many of us have a house or understand buying a house, and then there are house buying terms when you take a mortgage loan for 15 years and 30 years principally. Okay, most common terms are either 15-year term or 30-year term. Okay, now the question comes is whether to have a 15-year term and pay off the mortgage quickly, or to have a 30-year term and pay easily so that you save a little money every month by delaying from 15 to 30, but you will be paying more interest. So now that's a catch-22. Whether to pay early, you will pay less interest, you'll pay off your loan quicker, but your monthly mortgage will be high. If you defer that to 30 years, your monthly mortgage will be much less than the 15-year-old, but you will pay more in interest. Okay. So in general, that confusion, how to address it, that's where Anil will use, because he's a real estate agent. This is what he does for a living, selling hundreds of homes every year. And this is what his home buyers ask this question. So the advantage of paying early, the advantage of deferring it to 30-year, what are the advantages, disadvantages, which is what he will be discussing. Along with that, God forbid something were to go wrong to the homeowner's life, loss of life, health issues, various ailments, or physical disability. If that were to happen, then how will that have impact on that house, on that family, the whole 9 yards. So this is what he will be talking about. I'm recording this session. So those who have to leave early or have not joined or have joined late, they will go through this recording again and get the knowledge. So Anil, again, welcome for today's session, sir. It's all yours. Thank you.
Thank you, Dave. Thank you so much, team. And thank you everyone for coming today. So this session of today might be fast for some because I usually talk very fast because, as we all know, we come from India, we feel we have to rush, we have to catch a train. So if anyone has little bit of hesitation, don't think, just pause or ask me to pause or ask me a question, because it's okay. We all been there, done that. So thank you so much, Dave. So let me start. So before I go ahead, let me brief you about, let me share my screen so we all can see what we are talking about. Hold on 1 second. So. Okay, you all can see my screen. So my actually company name is Future Finance Services. So technically, just to start how I gone here, technically you see there are 2 F here. Okay. Just to brief, I started my career in fashion. This is me. I'm doing clothing designing, doing pattern making. I've been to many countries global, I've been to countries which, Pakistan, Bangladesh, Egypt, Honduras, Nicaragua, all those countries. So my thing was, my main bread and butter was fashion design, pattern making and all. So after working 30 years for clothing industry, I came last 10 years I did in US. So while I was in US, I was watching, how I was hitting a cap. And technically, if you guys might have seen, how this US industry works. I don't know, when we come from India, we have a big, fat CV, right? Very big, so many pages. So when I came here, my CV started shrinking, and now it's a one page. Because why? Because they only look for what they need me to do. They don't care how much experience or knowledge. They say, okay, how much I know and what I can provide as a service to the company. And the another thing is, here I noticed, like, we don't put a date, like when I finished my graduation or bachelor's. So that makes all of us think, like, this country thinks differently, okay? This country is basically looking for why, and they are concerned about how, okay? If you know how the things can be done and why you're looking for a job, that's what they care about. Like, if you know how it can be done and why you're looking, if you hit that and miss, that's how they decide. Now, expertise is something, we can gain on a one field, as Dave said, they call it domain, right? But if you know something which is like finance, money, because money is in a money business. So I started my career from fashion, gone to flips. I did flips in real estate, and now I'm in finance. I do these things still, but I do this because now I replicate my time. I learned a smart way now. The time is, everyone has this 24 hours. So using my mind, if I can replicate it and make use finance technology, I can grow my income legally in a better way. How? So let me go back to my slide here. Okay. So this is me, and this is now, when I was here, it was all me. Okay. All me means, like, I had a big nose, like I was like all nosy. I used to be like, adamant, because I have a lot of knowledge, and I knew a lot of how. Okay. So when I was here, it was like people have to come to me. Here I am, there they are. So it was like they have to come to me. So when I lost my job in 2017, that was a big blow to me. And I was like thinking, what happened? I was like so sharp, smart, everything. How come? I was losing jobs, like quitting jobs, but I was growing up. But then at 2017, I realized no more, Now I'm finding jobs which are like a lot less compared to what I used to earn. So that's where the financial domain knowledge came as a necessity, because that time I kind of felt like there are not many factors which I was not aware. So now I have an attitude of here, there you are. I go to people. Okay. So when I go to people, that what happens. See here. This is what happens. When I go to people, all these people became friends. Okay. So I have lot many of these like this. So now let's talk about us. So normal human family, okay, this is, let's say you came, you get bonded, you get married, you decide a family. What do? You get kids, and then you buy a car and home, right? That's what we normally do as a one diligent family. Now, when we start this, we take something called debt. So as in India, or overseas, we are trained like debt is bad. Okay, we should not carry debt. We should pay off easy, like we should pay off it fast. Okay, that's what we are trained. You should pay off your debt fast, ASAP. So when the lender comes, like let's say you are at this age, you are starting the cycle at the age of 35. So now you have two options. Till 30 years, you want to retire at the age of 65, correct? So 65, you want to retire. So you want to pay off your debt by, let's say, 50, okay? So in 15 years, you take a mortgage. If anyone don't know, mortgages technically is, when you borrow money from the bank, that's called mortgage. Mortgage terminology, you will be surprised how this word came, like mort plus gauge, okay? So this came from a Greek word, it's called debt trap. I was surprised when I heard this. I don't want my clients to know, because I don't want them to be scared, because that's what I sell. But that's how I was surprised. How come they designed this word anyway? So let's not go into that. Okay, forget it. I never told you. But now let's go back here. So this is a family, and now our goal is to decrease. So now if you have 30 years to pay off this, You paid off the house. Now you have a house fully paid off. Kids are married, car gone depreciated. But then you have taxes, which are increasing every year. And you have health, which is deteriorating every year. So you reduce your liabilities, responsibility, but you have a taxes and health. This is an ideal conditions. Okay, this is the ideal condition. This is something he and she thinks everything will be perfect. This is how I felt when I came to USA. Everything will be perfect. And the reason is we don't have a mentorship. That what you are basically. So any one of you who is actually attending the seminar, webinar, at least you will definitely going to learn something. I'm sharing something while I'm trying to figure out, sharing like, a couple of slides. Okay. So you've seen this. Now let's go back to the second slide. So what happens is when we plan our future, annually millions of people, this is a practical situation now, lose their homes. How I know? Because when I became flipper, when I was going to the clients' homes, I saw a lot of families, they were losing their homes, equity. What is equity? They paid, someone was paying the house, like they had equity built in. But just because they forgot to pay 3 months of a mortgage or something, they lost the house, and that was they lost the equity because they have to. Why? Because they have to think about it. I don't have time. Let me consult with my son or my lawyer. So there were like something or other they were thinking because they were not confident. So what they should do. So next thing, a lot of us, we don't invest. Why we don't invest? Because, oh, this happened, that happened. So what the maximum investment we do is a real estate. So let's say, if you see here, this is a chart here. Every year there is a one or other situation. We just gone through this. We still have it. Then this, then this, then this. You see, every time, every year there is some or other situation. But all the situations could be a reason for some people not to invest because of something called risk. We don't want to risk our money. So I'm just going over situation like what make people don't invest on time. Now, third thing is mentorship, education. A lot of us, we start investing from top to bottom. We start investing in stocks. We start getting a mortgage. We start investing in gold or silver, but we don't protect ourselves, our families. Why? Because we think we are perfect. Nothing going to happen to us. Now what happens? Look at the statistics now. This is a statistics. Most Americans lack saving. Okay. This is a saving percentage. This is a graph of yesterday market. Okay. A lot of people, apart of home, they invest in the stock market crashed. Why? Because again, we don't know. So that could be a reason for some not to invest, and some who think like investing, they lose money. Now, this is a statistics of disease like diabetes, major cause of blindness, And let's go back here. Road accidents, facts. These are facts here. Okay. I'm not reading the numbers because, but I'm just giving you like every 24 seconds, someone dies in the road. This is a fact. 1 in 4 people die of heart disease. Heart disease is a leading stroke. According to American Cancer Society, men have 40% probability. 1:4. Okay. Now what happens? We have a house. Some people lose house because of death. Some loss because of health. Some loss because of disability. And there is the fourth thing, some loss because of job situation. So how to protect it? We somehow have no mentorship. When we are buying a house, when we are creating our assets, we're taking a liability because, as I said, we think like debt is bad, we have to pay off. So we are running around fast, like we are trying to pay off this mortgage in 15 years because we don't want it. But what happens is every mortgage payment has 4 components. One is principal, one is tax, one is insurance, and which one is the fourth one? Interest. So most, when some clients, they want to pay off in 15 years because they want their home to be free and clear, because they want to protect it instead of 30 years. So what the topic of this agenda is, if we stretch our mortgage to 30 years, the money we save every month, if same money we invest in a product called IUL, then what will be the benefit and why we should do it? Now, first thing first, okay, as you know, when we pay our mortgage, it has 4 components: principal, tax, insurance, and interest. So when we pay our mortgage premium option every month, this and this are tax deductible. So if you Google all the rich people, they talk about OPM, OPT, OPK, and there are so many PPPP. But first thing first is others people money. What is money? Bank money. So now bank is giving you the money. So what we are trying to do, we are trying to stretch our dollar to work for us. So this money we're going to save from 30 years, instead of 15 years to 30 years, the dollar every month we are saving, that money we are investing here. And we are also claiming tax deductions for another 15 years. You get it? So a lot of my friends say, oh, I want to pay 15 years. That's good. But so let's recap it. So what we are getting a tax benefits. Number one, okay. Number two, we are getting dollar of today. Dollar of today means dollar has more value today than tomorrow. How? If someone bought a dollar, if someone has a dollar in 1972, in 2020, that dollar has a 10 cents value. This is from internet. So that's called inflation impact, okay? Not to argue, let's say make it 20, okay, just to keep it everyone happy. So now the dollar depreciated 5 times, okay, we lost it 5 times. So what we're doing, so that this dollar who had in 1972 has a more value, it can purchase more. So rather than after 40, 50 years, when it can purchase less, very small item, here we can buy a big item. So your goal is to use the dollar today instead of locking it for tomorrow, got it? So if you stretch your mortgage for 30 years, you stretch your dollar because you're paying less premium today. You're just dividing the premium part to the 30 years. Okay. So number one, number two, very important. Third thing is we're going to see how the dollar we are saving can help us make money. Make money. Okay. And then we're going to go to the other variables. If anyone has any question, you can ask me like while I'm talking. I have no issue on that. So another thing. So
one question, sir.
Okay.
When will we get these tax benefits? Means every month or when we once in a year, like
every year. So what happened is, Salja, when someone buys a house, so let's say I bought a house, the state government, federal government, they all want the money tax, So when you buy property, there is something called property tax. So you get a yellow kind of a green color kind of a paper in your mail. So if you have a mortgage, so the mortgage company, they pay that tax from our mortgage automatically to the state. So when you go to your CPA or tax consultant, you show that paper, and that's how you get a tax deduction. So that tax deduction is called SALT, Sales and Local Tax Deduction. So technically, as of now, thanks to Mr. Trump, earlier before Trump, we used to have like more value, like a lot of people like rich, especially they were buying big houses because they were able to write off big tax numbers. But since Trump came, he made it like 10,000 flat, which is like a good savings to the government. But 10,000 is still not bad. Most of the properties fall under $10,000 bracket. So you at least can get a tax deduction of 10,000 SALT deduction. Does that make sense? So you do it like end of a year when you file your taxes.
okay. So that filing a tax is that we have to go through some tax, like what is the name of the person, like the person who deals with the tax and everything?
Yeah, like consultant, like tax CPA or tax accountant, when you get a job, you get a salary check. So every year you have to pay tax. Like Uncle Sam is watching when we get our W-2. So he wants to get paid. So Uncle Sam, so to get him, we have to do our tax returns. So that's when you have to go to CPA tax consultant. Okay.
Okay, sir. Okay, got it. Thank you.
Okay. So Salja, so basically, so now everyone else. Okay. So now what happened is we talked about like, 3 main issues like death, health, and disability. Now the fourth thing is we all put our money in social security thinking like we are saving our money. These are additional slides I just put as a benefit. So social security, as per the information, people are saying that it will drain out by 2035 as it's going like this. taxes because of social security draining out might be higher. So if you see this graph, let me hold on. Okay, I can't. Anyway, so this slide basically I'm trying to show like taxes in 1921 were this 76%. Okay, there was some time it was even 96%. Like this is the numbers here. So the taxes usually when every year, this is how the taxes are going. Right now we have so many tax brackets based on the income people make. So the two things I'm trying to share is one is social security, which we pay every year, every month in our salary. Second thing is a taxes component. So let me brief. I don't know if you guys know, because as you asked me a question, just to brief, like when you get a salary, so this is how you have a federal tax, state tax, property tax, and then a couple of other taxes. But then this is a portion you get, like that's called take home salary, right? Not property tax also part of your take home salary. So from this take home salary you pay mortgage. Okay, so that mortgage is basically payment for your home. Okay, now to save income, some of us, what we do tax planning. And for tax planning, what we do, we put our money in social security plans or 401k. Okay, social security is like automatically deducted every month from our paycheck. Okay, so that's what basically I was trying to show. So social security is like in India we have it, pension plan, we get like money when we retire. But unfortunately, as I shown the slide, by 2033 they are saying social security might drain out. Don't get like scared, but that's like in future. Okay, but that's how they are saying, but we have to pay for it. And 401k is our tax deferred plan where we put our money from our paycheck. So when we retire, we have some income to save for our future plan. Okay, I'm just giving this idea because a couple of slides are basically correlating this. So bottom line is, when we are growing, this as per Time Magazine, 401k also has a situation, it's a lousy product, blah, blah, blah. They talk about social security, also they talk about the funds will be gone. So more or less what I'm coming back to here is at the age of 50, okay, or 85, as you get older, there are two major things happen. The coverage you get might go down, the price go up. This is about a insurance. So what happening is, when we as a human, when we are planning our life, as I showed you this one here, when we planning our life, I remember I said at the age of 65 we want to pay off. So what options we have? We have to have a retirement income. So for retirement income, we are dependent on 401k, and we are dependent on our social security pay. But since social security, as I shown, like what if it's gone? So then who gonna plan our retirement? That's the question. Okay, who gonna pay for our retirement? So who gonna pay for our health? So that's the two major reasons. And as I said, what if the taxes are too high? Okay, so remember I showed you in the screen, when you have paid off your home, the taxes and health is two components which always go up. So if health goes down, you need money for this. If taxes go up, you need money for this. If social security go bankrupt, you need money for this. So bottom line is, you need money when you retire. And since we are not working after 65, you need money. So coming back to the slide, how we can take out money from mortgage to pay for our retirement. You got it? So, if my slides are little techy, so if anyone wants to correlate or connect, if you feel like, it's going little beyond, please ask me so I can connect the dots. Okay, it might help others too. Okay, because okay, so there is a product. I'm going directly to the point. So there is a product, that product called IUL index insurance life contract. Okay, index life insurance, you can call it. Okay, so what this product does, it's a revolutionary product, came in 1997. That what basically they wanted. So what this product does, it provide you 4 things. One is growth of 10% of the money. So remember I showed you the stock market go down. So in this you're getting a 10%. Second, the best thing is there is zero flow. So money will never go down. If you have a stock market investment, money will never go down. You get a tax benefit. Remember I said 401k and social security, we are using pension. So in whatever money you invest in this life insurance, the money grows tax free. And the fourth thing is the protection, like life insurance protection. So, since the money is growing tax free, you can borrow money from this plan for your future retirements. Okay. So all these are covered in this policy: disability income, retirement income, life insurance, accelerated living. Means when we retire, if we have any medical conditions, all these benefits are covered. We get 8% to 10% growth in that policy. So if you leave your money in a bank, so bank usually give 1%. So 10,000 money in the bank after 70 years will become 20 based on 72 rule. This is a rule given by Albert Einstein. So any interest you are getting, let's say you're getting 1%, it will take 72 years money to double. Okay. So in the banks, let's say they give 1% interest, right? So it will take 72 years money to double. So if anyone is a 35 years, like a homeowner who's buying a house, if he is leaving money in a bank, it will take 72 years. Too late. He's getting no return. So if he has a product where he can park money, where he's getting 8 to 10%. So if $10,000 parked in 8% product, it will become $160,000. You see this? $160,000. And if you have a park money, if the product gives you 12% based on market, it will become $640,000. Okay. This is again based on a rule of 72. 72 divided by 12, it makes 6 years money to double. Okay. This rule is very important. You all should remember this, because technically it will help you decide where you should be parking money. Now, the same formula we will use to our benefit when we are calculating why stretching our mortgage. It will help. Now, as I said, this mortgage help, this IUL product help you to get chronic critical terminal coverage. So these are the 3 main diseases which we are bound to go through in our life after retirement. So this product is a magical product, covers all these expenses if need be. I'm not focusing too much about this product right now. I'm just giving you a glimpse, because main idea is I want to go back to the mortgage, like how we calculate. Remember I told you, like, this product has no negative. So when the market, right, is the market. Okay. When the market go down, in this, your money is never going down. Money is always staying like zero. Okay. So now, let's go back to the mortgage part. Now let's talk about mortgage. Okay. So before I go out to the mortgage, anyone has any questions, like, what is a mortgage or anything, like how the monthly 15-30 years process work? Because this is now we'll be talking about the buying a home and what is the mortgage and all that stuff. Anyone has any questions? Because I will just use a calculator to calculate the monthly. So we'll go from there. Or anyone has any questions before what we discussed as of now?
Anil ji, I have a question here. You were talking about the previous one. You said you were talking about index life insurance.
Yes.
So, is it particularly like provided by a particular company, or is it available with any life insurance company?
A very good question. So basically, there are many companies who are now providing IUL product, but because of the competition. So this is a slide. Let me share this slide. So you see these companies. So these companies right now are providing this IUL. Okay. So AIG, this is a theme, North American Nationwide, FNG, Besto, and then these are other companies. So AIG, I will do a policy today to show you how this IUL product looks. But there are other companies too. But knowing me and knowing kind of like when we come from like the country we come from, we want to get the best. So if you ask me personally, knowing the years of experience, the years of industry expertise this company has, so I basically love these 4 companies. FNG allow me, because I bought policies from my kids for FNG, FIGs, Fidelity, and Gold. So in this, they grow money using an index of gold, real estate, and S&P. So S&P is an index where like 500 companies collectively, how they are growing, that's what they base their index accordingly, correct? So if you see a couple of days, the index is falling. So there are multiple reasons, but gold is reverse of index. When the market is like having a fear, the gold goes up. Real estate also is a kind of a, when the market has a lot of demand, the real estate goes up. So for kids, I use FNG index life insurance, IUL, because, you know, technically, like I have a girl and I want to give a IUL policy as a gift when she's going to get married, because that technically I'm giving a gold to her, which will grow tax-free, covering medical. And the best thing is no one can steal it. No one, this is a non-declared fund. So nothing can be parted. So if tomorrow, let's say if any infatuation somehow, you know, husband and wife not feeling together kind of a thing. So in that case, this money will stay with her. Okay. AIG usually I do for people like me, you know, who are in 30, 40, 50s, because that's more secure, more, and they have an index which are more S&P kind of a index, you know, less volatile. Okay. And they, because all the policies of IUL, as I said, they have a floor. This one.
What is the floor? Floor meaning?
Floor
0% is the floor. Yeah,
0%. So market, let's say, goes 20%. Okay. So if you are, let's say, in 20 as of today, so if market goes 20, you will only get 10 because 10% is your cap. But tomorrow, let's say market go down, it will lock at 0. Now, if from the in the stock market, it will go from the point where it crashed, correct? It will go from here. But you will get your growth from here. So you have a benefit of this much. You got it? So this is the benefit of IUL. So you will never lose money. The money gets locked. So what we are trying to do in our, you know, this presentation today, we are trying to see what if, okay, now let's say same have husband, wife, okay. So husband and wife, they have a platform, they have 2 kids, and they have a car, and then they have a house, okay. Now they have a debt liabilities, so which are like $500,000 for a home, okay, and all together. So we are trying to insure this home. So all the way for 30 years, okay, this is secure. Now rest life, let's say he has another 40 years, okay. He's in 35, he goes 65, he has another 40 years, so 105, okay. All these years, he will use a insurance of IUL. So in 15-year mortgage, usually $500,000 house, payments are, let's say, 25. I'm just getting you guys ready for the exact numbers. But 30 years, it will be 15 on an average. So you are saving $1,000, okay? Only thing is in this, you are paying your mortgage in 15 years. In this, you are paying your mortgage in 30 years. So there is a loss of interest. So we're going to see what loss of interest we have and what money we are making by using this $1,000, half of that if we invest in IUL. So what happening is we are still saving money of today, still getting a protection of this 5,000 from the day one, and we're getting a lot of cash at the 65 age. So that cash we can use for our retirement. And we have a medical coverage. So we are secured from day one. From day one, we have medical coverage. So that's good. So we have medical coverage. And then we have a protection of market, no loss. So we are not like leaving our money, our kids, our home, our family into the market. We are not dependent on social security or 401k or anything else to crash or give us a hard time. Okay. Any other question?
Anilji, I have one question. Like, what are the premium we are paying monthly for IUL? So is it tax benefit? Like, we'll get the tax benefit for that?
A very good question. So basically what happened is IUL policy, okay, insurance. When you claim your funds, okay, fund, let's say you have a small dollar here, okay. So let's say this is your paycheck. So you have 2 options. You can defer the tax. Like you can say, hey, Uncle Sam, this is a Uncle Sam, okay. Like Uncle Sam is like a IRS. So you say IRS, say, look, I want to pay you tax now. Take my tax, but let me grow my income tax-free for life. Okay, you are in 35 years. Let's say you are making $100,000 today. So which option you think is better? Paying tax now, let's say today tax is 10%, or paying tax later after 30 years when your income might have become like 1 million, which is better? Not, let's say 300,000, okay? Which you prefer, paying tax now or paying tax later? Hello?
Maybe now.
Correct. So what happened is in 401k, we defer, we don't pay tax now. Okay. That 401k is a tax later product. Okay. I will cover that also in a slide. Tax later means we don't pay tax now. This is a like something we are educated in a job. Oh, let's not pay tax now. So we are thinking, okay, we are not paying tax today, but we will tax later. So what happened is 401k is tax later product later. Okay. Remember this. So what happened is, so 100,000 stay 100,000. It's growing. Now at the age of 65, you have to pay tax. And let's say, as I showed, remember 1921, the taxes were 76% USA. There was a time in 1933, they even gone up to 96. Google that. You know, maybe I have a couple of years here and there, but that was the taxes were. Imagine what if you are retiring at the age of 2040 and the market, or maybe 2033, and taxes, let's say 70%. What are you going to do? All that 70% of the bloated amount you have will be gone. You got it?
Yeah.
So now insurance is same. So you pay tax now. Okay. So you pay tax now, which is small, dot, and then money grows. Whatever you have here is your money. You can use it before life. This is what we very interesting, because a lot of people, they don't like insurance people to walk in their home. They say, oh, no. You know, you basically, because people think someone has to die to make money, beneficiary. But now insurance became index. Index is investment, okay? Index insurance. So insurance company are blessed by code 7702. This is important. Remember this, okay? Insurance companies are blessed with a code 7702. So what happened is, whatever money you are putting in insurance company, they grow tax free. A lot of people don't know. So only product people know is Roth. Even your CPA might not know. Why? Because CPA are trained to talk about Roth, because to sell insurance policy, you need a license. You cannot talk about insurance company policy without license. I did textile engineering, then masters in NFT. I took 30 years. But for these, I have to take 20 hours of exam. Forget about years, 20 hours of exam, and I can talk about this. So I was like, you know, what if someone told me? Anyway, now I'm sharing this information, you guys. So this license is very powerful. Life insurance license is very powerful. 20 hours of license allow you to become a vocal guide for many. So now you pay very little tax here, but the money, whatever is growing, is tax-free. Now this money which you have grown tax-free, as I said again, you can use it for your retirement. The insurance companies are covering your medical, and the money is growing tax-free. But that's all part of a IUA. Okay. Any other question?
Yeah, Anil ji, you said like once you invest in 401k, it's tax deferred, right? Like end of the day, when you are about to get the 401k amount, I mean, like you're saying that we need to pay at the end of the day when you're trying to use that money. But now, as of now, say for today, I am earning $100, and out of that, I'm putting my $50 into that 401k plan. So as of now, I won't be paying the tax over there, but end of the day, I have to pay the tax. But as of now, till today, I was in a assumption stating that I mean, like after 65, when I take the amount out, I'm not supposed to pay the tax. Can you please explain this to me? Thank you.
Well, you are not the only one, because this is like, you know, thanks to WhatsApp, all this TikTok, all that stuff, like people are getting more educated. But with that education, you know, it's unfortunate that we have to get educated through internet. So you are 100% like good on part of saving money. But look at this slide, okay? I have this slide. If anyone wants to take a picture, you can take a picture. I don't know why my computer is not letting me zoom here. What I should do? Let me see. I'm not good in this stuff. So this is something
We
like
can see it,
this.
Anil. It's decent size. We can see it.
Okay.
Mortgage calculator you're showing, right?
Okay, I'm trying to show a slide now.
Okay. This slide, tax now, tax deferred, tax
Yeah,
advantage.
yes.
वहां पे zoom होगा ना, zoom option है ना.
Yeah, I'm trying to. Okay, yeah, oh, now I see. Okay, so here. Got it. Thank you. See, I should have asked you first.
No problem.
Okay, guys. So this is something very important. So now look here. Let me zoom in 100%. So this is a tax now. Okay, 401k is tax deferred. So tax deferred means a tax later. Okay, the IRS not going to let you go. They need tax either today or tomorrow. It's you have to decide when you want to pay. So what happened is in this product of so in this 401k, you are putting before tax dollars. You are basically you are putting your dollars and you are not paying the tax. But tomorrow when you take out money, okay, your money is locked till 15.5. You cannot take out money before 15.5 unless you are ready to pay 10% penalty for withdrawals. Growth and principal is taxed at distribution. See this? So if your money grows, let's say you have a 401k in company managed Vanguard account and money is growing like this. So at the age of, let's say 60, right? You say, okay, you know what, let me take out, let's say you are putting 100k, 10k every year. So in 30 years, you have 300k, okay? Now 300k became 600k because you're getting a 100% growth. So 600k, if the government has a 50% tax bracket, you will get 300k. You get it? You with me?
Yes.
Now, contribution has limits. So like right now in 2022, the limit is 20,000. This one is 20,000. Now there is another product called tax advantage, okay? Or you can call it tax now. So in this, there is a product called Roth. Roth, unfortunately, some families don't qualify because single, if you are making 129,000 or less, then you can contribute $6,000, okay? But after 50, you can contribute $7,000. But if you're married, you can maximum 250. If you have 250 or less, yes, but if more than 250, you can contribute. Why Roth, which is tax now, means if you're making 100K, you pay tax as per today, has a less contribution limit, and 401K has a 20,000 contribution. Why? Because Uncle Sam is greedy. He wants you to put more money so he can get more money at retirement. You get it? Yes, no?
Yes.
Yeah, so what happening is, so Roth IRA is better, but unfortunately, Roth has a limit. Now what happened is, there is other thing, contribution withdrawal of 44,000 cause 85% of Social Security to be taxed. Can you believe it? I was not thinking of putting this in a slide because it is too much of information, because mortgage itself is very technical. But think about it. If you are making a money and you want to withdraw money at the age of 60, okay? Now 60, you want to withdraw money, Social Security comes at the age of 65. 60, you are still working. You say, you know what, Anil, let me not take out my 401k because the taxes are 50% right now. Let's see, maybe in 5 years, Mr. Biden is coming, maybe he will reduce the taxes and all. So let's leave it in the bank. So you go to 65. And then what happens? IRS jumps in. Oh, we have to pay you Social Security, but since you are taking out money for 44,000 every year because you are making money, we have to put 85% tax on your Social Security. So if you have a Social Security of 5,000, they will put 85% tax on it. You're going to say, what are you going to do? You cannot do whatever gone is gone. You cannot do it. You cannot correct it. One more thing, RMD is at the age of 72. I'm not going to tell you RMD, that's your homework. Google it. That will give you a lot of information, okay? RMD is at the age of 72 means if you don't take out money, let's say you say, you know what, Anil, I don't want to withdraw my money because I will rather leave it in the bank and, let the money grow. Maybe my kids can enjoy. So what happens? You give it to kids as a heritage, the government gonna do 50% excise tax on it. And they're gonna pay whatever tax they have to pay anyway. Remember this tax they have to pay? So if I have 2 kids, both are good, and they are both married, They are thinking, oh, my father gonna give me money. He has a property and then he has a 401k. Uncle Sam comes in, no, you forgot about me. I need 50% excise. And your dad never paid tax. And then the kid's gonna hate me. They're gonna say, what the hell? You know what our dad was doing? He was using all the dollar for himself. He never thought about us. And then Uncle Sam gonna say, well, I don't care. I'm gonna take my slice. And then whatever left, he's gonna take another 50 because size, and the kid's gonna get this. And then this is, as I said, 52 means at the age of 72, you have to, they force you to take out. Otherwise, they charge 50%. Got it? Now, this is something magical which we have in IUL product. Now, a lot of people don't know about it. A lot of people don't want to know about it because you know why? Tax consultants somehow can't sell this because they don't have an insurance license. So they don't want you to know about it. Second, insurance agent somehow they want to sell because it's a marketing, right? That benefit is covered with the term insurance. Term insurance is something everyone is looking. If you call today, even in the meeting which a lot of us are attending today, you know, most of us in my real estate also, if I go out, a lot of my clients who have bought a house, they say, Anil, just give me a term insurance. But I'm going to show today, if our time permits, and you guys are still like with me, that, you know, getting a term insurance is technically losing money for nothing, giving it away for free. Let me show you one more slide here. Okay. So, okay. This is a 3 type of insurance. Okay. This is a bonus that was not part of this. One is called term. One is called universal. You can call it like whole life. You know, my writing is not very good because I used to like love my engineering, you know, because we were like trained not to write, just copy paste, copy the front guy. So term and whole life, and the third is IUL. Okay. And then there is a like something called variable also. So term is basically you pay fixed premium. You pay this premium, okay, constant, very low. Let's say someone who wants $1 million policy at the age of 40, his premium will be $1,500. Okay. I know it because I did for someone. So for 30 years, if he pay, he is how much? 70 years. Okay. So 70 years, he has $1 million worth of protection. So now he has a house for 70 years. He thinks like he's protected. But as I showed you in the previous slide, so after 70, what he gonna do? He has no protection. So he paid all $45,000 in 30 years for nothing. And why people take 70? Because as per Time magazine, people who are born before 70, their life expectancy has gone to 85. People who are born 80 and 80 plus, they might cross 100. And people who are getting birth in 90, they might cross 120. Don't quote me, it's a Time magazine. Google it, okay? So what are you going to do with the 70 years? Nothing going to happen. So how are you going to survive, let's say 15 years, or let's say 100 years, if you cross 100 years? Because right now we have a pacemaker. If anything happens, they put a pacemaker, you know, it makes you survive, right? So there is a medical, there is a road, all that stuff. So that's the reason I usually don't suggest, but it's okay if you want to cover your liabilities, still better than nothing. Universal is basically whole life, you know, and IUL, the difference, let me share that also. So whole life is most popular product, and IUL is the new product, came in 1997, okay? So whole life, no medical coverage, yes. Here the death benefit is constant. Here you can flexible. You can have a increasing death benefit or constant. You can do both. Here the premium, like the cash value is taxed. Here cash value is added to the death benefit. So what happens is it becomes total death benefit. So because death benefit is always tax free, so cash value becomes total tax free. Okay. And the fourth thing is here the cash value of the beneficiary, let's say if the person who owns it dies, the cash value goes to the company because they're only giving you death benefit. This is a lot of people don't know. Unless you have to put a rider and you have to talk to the whole person who is selling you whole life. Okay. So in this, you don't need to know automatically because automatically one piece. So if the benefit, the person dies, the entire money goes to the beneficiary. So now basically what happened? If you are before life, after life, tax free, you can withdraw for your income protection. Let's say anything happened, You get a medical, chronic critical terminal. You have a, like protection for your life on the day one. Okay. So any question?
Which one is a tax free? I don't understand.
No, both a life insurance is always tax free because whatever contribution you do, the beneficiary get all the money tax free always. Only thing is, in IUL product, you can withdraw money also before life for your benefit, for your college planning, for your kids planning, for your home. Like you withdraw money for my flips tax free. So that's the benefit in the IUL. Like in whole life also you can withdraw, but you have to pay interest because in whole life they make it as a dividend. You know, whatever you the money. Oh, sorry, the whatever premium you pay, it's like a dividend.
Oh,
You got it?
yeah, got it.
I have a question.
That benefit is a plus dividend. So dividend is always taxed, right? So if you take out that portion, it's taxed, and plus you have to pay 2% loan because in whole IUL, remember I said zero floor. So when you take a loan, it's a 0% interest. There is no interest when you take a loan because it's a wash off.
Hmm.
Okay. Any other question?
I just want to, Benson here, just want to go back to the 401k. Is there no way that there's 401k Roth option?
Yes, that's called backdoor. What happened is a lot of people, so Biden, thanks to people who voted Mr. Biden, I also voted, no offense, but Biden is coming out with a new law called BBB, okay? Build Better Best. That law is still in the paper, but he's trying to plug the whole law of a backdoor Roth conversion. So Roth conversion means like a lot of people, when they are in 401k, when they change their job, there's a phrase called rollover, okay? So rollover period phase is 2 months. So let's say you are lost your job. Now you have a two options. You can do IRA or you can do Roth. So that's where a lot of people, they convert their 401k into Roth. But then again, you cannot do more than $6,000. That's called regular law. Then there is a mega Roth. Mega Roth is for mega rich people. Mega rich people can do 40,500. But Mr. Biden is trying to plug this hole so no one can do it.
So no rollovers is allowed in whenever he gets his plug.
Right now you can do it. Like if you ask me today, yes, you can do it. But there is a proposal in the books called Build Better Best kind of a law, which they are working on. So if you do Google, you might be able to find this article. So where they are thinking of like bringing that as a law to plug that rollover. But as of now, because rich people, sometimes they want to avoid taxes because they understood very easily, like, if you have a money sitting in the bank, is bank not going to give you anything? And the dollar today has a value, but if you want to grow it tax free because you don't want to pay cumulative value, huge money, like, taxes on that money. So what they do, they try to do Roth. So the Roth option, because the conversion is a possibility, right? You have a 401k, you have a 2 months rollover time, and you convert 6,000 in a rollover, right? So, but that once the BB law is passed, then that conversion might go. I don't know.
So
what's the proposal from the Biden?
Yeah. So my thing, I mean, I know about 401ks because I have a 401k, but I called my company and I told them that I want a 401k Roth account. So that actually it is an account which is a 401k Roth. So I don't know whether they actually did it in a Roth format, because I just want to be clear on that. If you can answer me that question, because my company.
It depends on the companies to companies. Okay, let's say some companies, let's say medical companies, right? They have something called 403b, which is better than 401k. Okay, so it depends on the companies, like what companies are looking for, because ultimately the bottom line is if you are getting a W2, your savings are controlled by your company. Okay, unless you create your own company.
I'm working for Verizon Corporate, so my W2 is coming in.
Yeah, so you have to talk to your company CPA and ask him, hey, can I do Roth of contribution $6,000? If they allow, then perfect. Otherwise, usually, the option is, let's say you change your job tomorrow, so portion of that you convert into Roth. Every year you can contribute $6,000 before 50.
Right. No. But what I'm trying to say is,
listen. The idea and the technology which I'm sharing with you, IUL will beat everything else. You don't even need to worry. I can see you are thinking now. Leave it the money where you have in 401k. If I would be you, this is what I did. Okay, I'm sharing what I did. When I got fired from Aeropostal, okay, 2013, I did my 401k rollover to Roth. Then when I was in Macy's, okay, when Macy's last company 2017, like I left as a VP design. So that company gave me 401k again. So I put that money again in my old 401k. That time, no one told me there is something called Roth. I had no idea what Roth is. So I put all my money in IRA account. IRA, sorry, not IRA account. Okay. So in IRA, what I did, my money is growing. I definitely has to pay tax when it will mature. But at least it's IRA. There's nothing much I can do. But now every year I don't put more money in IRA. I put in Roth. Okay. And I put money in IUL. Why I put in IUL? Because in IUL, as I said, let's say I took a IUL for me for 250, right? Every year, let's say there are two premiums I can do. One is a guideline premium, one is a target premium. Guideline is coming from the IRS and target is coming from the insurance company. So IRS tell you how much maximum you can put. If you do any 1 cent extra, then it's a taxable product. Okay.
IRA, you can give the income limit. How much is the income limit? Roth IRA, Roth IRA. Roth IRA is the income limit, correct?
Roth IRA income limit for single right now is 129,000. Okay, 122 to 129. So if you are single, if you are making salary more than 129, you cannot do Roth.
Oh.
You have to check your CPA. If you are married, I think it's 250. But you have to talk to your CPA. I'm not a CPA. So those numbers I cannot tell you. I'm just sharing with my knowledge.
Hi.
Okay.
I think you are correct.
Okay. So, but what I'm trying to tell you about IUL, if you do, let's say there are three things. Okay. Me, my wife, and my two kids, right? So I can buy 4 policies, correct? So now, let's say I took 250 for me, 250 for my wife. Now 250 policy guideline premium as per IRS and then target premium as per insurance company. So if I do target premium, that premium is insuring me for 250, but at the same time, since there is a floor of 0 and a cap of 10%, my money, whatever I'm putting is also growing. You got it?
Yeah.
So now at the age of 35, if I start by the age of 65, it will double. Usually it will double. Okay. It's not perfect, but double. So now I covered myself from 250 from the day one protection. I had a medical coverage from the day one for 250. And at the same time, the whatever money I had, I can take out that money anytime for my flips, for my college, for my anything tax-free. You got it? This is something which is not an option in a Roth or IRA. A Roth or IRA, you cannot take money before 59.5. But here you can take money anytime. You got it?
Yeah.
So why should I worry? You know, I am okay whatever government has decided because there is a parallel pigeonhole available, which a lot of people don't know. And my goal is to use that pigeonhole and become expert. That's the reason I took an insurance license at very old age. I don't look old, but I'm old. So with that age, so I took an insurance license just so I can get myself expert into this. And I got a license from multiple companies just to see which one is better. And as per, Salja's question earlier, I like AIG for adults and FNG for kids. Now, so if I have money putting here, I'm getting a protection of day one, right? 250. Now, if my house, let's say, is $500,000, right? I can divide 250 for IUL and 250 I can do term. So term is like very minimum premium. Remember, we talked about term is always less. So 250, which I'm putting, let's say if I have money, I need money for anything. So with that money is growing tax-free. So I will show you the numbers, how it works. Well, let's get back. Let's get to the numbers. Okay, it will make more sense. Any question about IUL or anything else now earlier?
Yeah, actually, I have a question, Anilji, here. Initially, you said like regarding the 401k and rolling it over to IRA or something like that. So you said if you have your own company, then you can, I mean, like if say, suppose we have our own company, say suppose we have our own LLC kind of thing. So do you, I mean, like, according to that point, can we set some rules for this 401k kind of thing, or what do you suggest?
Well, if you have your own LLC, let's say, okay, you are paying payrolls. Like I have a LLC, okay. My kid is 15, my other kid is 9, my third kid is 23. She is in India doing law. But my 15 and 9, they both are on my payroll. Okay. And I did Roth for them. I don't do 401k.
Okay.
I did Roth for them because Roth, luckily, I can do max 6 for them. So they both are payroll. So I show them as a low income employee. They are low income, you know. So that income I show them as the income they are making from me, and that's a loss to my income on my company. So there are so many other loopholes. We can talk about it, tax planning in this other seminar. But to your question, if you are thinking there is something called SAP IRA, and that's something you have to talk to your consultant, CPA, based on your income, employees, and other stuff. But yes, you can do that as an option. So, you know, I'm not a CPA, as I said. I'm just giving you
No. I'm just asking the silver lining of it. Yeah.
Yeah. So trigger is basically, you know, a lot of people ask me, how are your kids are employee? I said, well, because I pay them salary as a low income, but at the same time, they have an IUL. The reason I do IUL for my kids, this is something I told in the last seminar. IUL is an insurance. Money gone here. It's like a no one can see. It's like a khulja shimshim kind of door. Okay, no one can see. IRS cannot see what's gone inside. And what's growing inside, no one can touch it. It's like a big, huge box. No one can see. So my kids, like who are very small right now, they're throwing money here, pring, and IRS is taking small cut, and IRS is happy. You know, IRS, he or she, they are getting small cut, so they are happy. But whatever going in, it's growing. Imagine if a kid up to 1 year old, if I show you, if parents put $100 per month, that whopping money become million. And now, if you know this, and if anyone you find in the globe, and he says, oh, I came to USA, I'm not millionaire, and I'm not like, you know, I'm struggling, then they are struggling or stuck because they are not coachable. It's not anyone's fault, their fault. Because they just want to be in a cocoon, you know.
So you mean to say, if we invest the kids thing in Roth, then will it be useful for their education? I mean, like, say, suppose we can use it.
No, Roth, listen, actually, I should have completed my sentence. So basically, IUL is a non-declared fund, right? So whatever money you put, it give you growth, safety, protection, and tax, remember? So, but IUL money, whatever you put in, it's non-declared. Non-declared means whatever money you don't declare. So now tomorrow my kids are sharp and they want a loan. So FAFSA, if you put money anywhere else, even Roth also, it's a declared, okay? I have to declare to IRS or to the educational and so how much income I have, money I have. So my kids, because Roth will grow, may not get a scholarship, FAFSA. I was late actually. When I started Roth, that time I had no idea about IUL. If I had known IUL, I would have never done Roth for my kids, okay? But since I started Roth for my kids, so I'm doing Roth for my kids. But the thing is, that money, whatever I'm putting in a Roth or even the bank or my properties, all is declared. We have to declare when we do our educational scholarship. But anything when you put in the IUL is non-declared. You got it? But so let's say tomorrow my kids want money. As I said, you know, if I have a money, let's say if I put every month, I'm putting money like this much money. Okay, let's say I'm putting this much money, $500. But money is growing at let's say 6%. Okay, growing. At this age, if I want money for my kids, I can leave 10%. So my policy is still running, so it's not dying, and I can take out money for my kids' education. But that money is non-declared. So that's something if I need, I can. If I don't, I don't.
Oh, okay, got it.
Okay.
Yeah, thank you.
So let me go back to the main thing which we were basically. So let's say this is a calculator, okay, calculator.net. Someone has a home of $500,000. All the variables are keeping constant. He is doing a 30-year mortgage. Okay, for 30-year mortgage, monthly is coming 1836. Okay, I have this in number in my.
I'm seeing a blank screen. Maybe.
Oh, sorry.
Yeah.
Okay, sorry. Thank you so much. Okay. Okay, so now here. Okay, so this is a mortgage calculator called calculator.net. So we are thinking hypothetical. All of us, okay. Because I'm a realtor, like most of the homes which I'm selling, they go with $500,000 on an average. So I'm just keeping that as a number. So someone is buying a house of $500,000. So let's say he's paying for 30 years. So mortgage would be approximately 1836.61. Got it?
Yeah.
This is a calculator.
It's a rate calculator. Yes.
Yeah. Basically plus minus here and there. I'm not going to the variables. Anyone, any other questions? This is something people who are sitting on the mortgage industry calculated, because there are 4 variable: down payment, interest, and then there's the home insurance, PMI, blah, 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 everything. Okay. Now I put that number in here, 1836. Okay. Now let's say I show up. I want to make money. I want to help my client. I say, sir, why don't you do 15 years? Because you will be able to save a lot of premium. Only thing, you pay more now, but you save your, like, you've seen the Quicken Mortgage advertising. Why you pay more if you do double payment in a month? Even my wife, even we are doing double payment as of today in one property. We are still doing double payment because my wife don't get it, but we got it very late actually. It's not her fault anyway. So now the 35 years age mortgage for 15 years is this much. Okay. So that if I do different, so extra $1058 the person is paying every month if he move from 30 to 15 years. Knowing that dollar has a more value today, I will rather not give money to mortgage company. I will rather keep it and I will pay 30 year mortgage. You get it? This is 30 year. This is 15 years. Because I want to use that dollar of today, because dollar will lose value because of inflation. So now, but the only problem is how to convince someone, because if I do 30 year, I'm paying this much money, but if I'm doing 15 year, I'm paying this much money. So there is a loss of $140,000. So is it worth it to pay more and save money, or pay less and pay more money? That's what we are trying to do. Okay. Everyone okay?
Yeah.
So now let's go back to the AIG. So let me log into my AIG website. I'm gonna do a real live example policy just to show you guys how to make a policy. Okay. So the reason I'm sharing is so you can see the numbers right on the spot.
So Anilji, is it a part of HDI?
Actually, very good question. So basically, okay, let me go back here again. So Uber, right? Uber, Amazon.com, they all are basically companies, they are providing service to C2C. This is a trend of it today. If you are in any business or anything which is not catering to these 3 things, to me personally, we are buying our time to make money, like time, and time is 24 hours. I tried everything. I did eBay, I did my vending machine business, I had a clothing business, I had an IT company also. The only thing now I learned is it's time multiplication. You have to multiply time to make money. Otherwise, by yourself, you only have 24 hours. Bottom line. Now, number 2, if you see these businesses, any business you see which is growing, and then you think of this, what is CNC? Driver and client. They both are bringing their own tools and thing, only using a platform. Amazon.com. The seller is and the client, they are bringing, even the seller, even the distributor now. Imagine that Amazon has a distributor trucks. They're putting their own truck of $90,000 on a lease to the Amazon.com. Amazon is not buying those trucks. They're letting these drivers buy their trucks. So Amazon.com is only providing a platform. Uber is only providing a platform. Facebook a platform. Twitter a platform. eBay a platform. All the platform, they keep a penny out of it, but let the other people grow, make money. Only problem is this platform, they're keeping money to themselves. They're letting you make money for the time you invest. Okay. So if you do nothing, you make nothing. If this consumer sells nothing, he makes nothing. Clients get nothing, makes nothing, right? Same way in Facebook. If you do nothing in a Facebook, there is no social media. If you do eBay, if you sell nothing, you make nothing. So how you make nothing? Same way, HGI is a platform. HGI is a company which is having a financial product. Like when I became a licensee, right? My goal was to get a knowledge. Because by law, you have to park your license somewhere. I can park my license with the New York Life, Mass Mutual, Prudential, but those companies, are doing only this thing, whole life. So if I park my license, I'm an employee. I don't get an opportunity to create my time leverage. Okay. So they have a platform where I will get W2. So if I want a W2, I can go and go back to my clothing industry, right? I have more money there, I make more money, right? So basically here's the time leverage, and the product is basically, because if I don't like something, I won't endorse it. Because if my family, my wife knows someone, they're going to come back to my home if I sell something which is wrong. So that's the reason the knowledge I'm gaining, I'm sharing. So technically my plate is full because I have a 24 hours. Out of 24 hours, if I do nothing today, then all till, let's say, retire, I have to do same thing to get the dollar coming. So that's a problem in the traditional methodology. If I sell property, I make money today. If I don't sell tomorrow, I don't make money tomorrow. But that's part about the AGI. We can talk about the AGI again. But yes, I park my license with AGI. So AGI basically allow me to be free. I can be a realtor, I can be an investor, I can be a flipper, I can be a consultant with the clothing industry. I can still do what I'm doing right now. Knowledge sharing, and I let my clients pick. If they're educated, they say yes. If they are no, who cares? That's how it is. Okay. So let's go back to this one here. Let me go back to policy. Okay. So I will take real quick illustration, which I have already saved. So this is a person, his name is, let's say Demo. Okay. I put his name Demo and male, and I put his age as 35. Okay. Now this is preferred plus based on the health. Like if your health is good, you are in New Jersey. This is a target premium. Remember I talked about two things, when you do a policy, there are two things. One is the target premium, one is the guideline premium. Guideline is coming from the IRS. This is a maximum. You want to grow your income maximum, you do guideline. You do target, you want to keep the insurance. So you have provided protection to your family. Okay. That protection is important, you do this. But you want a lot of money here, you do this. Okay. Since you asked me a question in our SGI, we only prefer to do target. We don't push clients for guideline, because guideline is a lot of premium, good premium. I will show you. So if I do premium of guideline, I will make more money. But we do target because we want clients to be happy, and then they decide. Okay, let's go back here.
Yeah.
So now 250 is the premium. Now let's say the guy has a house of 500,000. Okay. These are 4 index you can pick. Remember I talked about you can pick an index. Let's someone wants to make money. Let's say he wants money at the age of 65. I can do that. This is basically option where, the death benefit will increase or level. Remember I said in whole life the death benefit is always level. So we can do level or we can do increasing. Let me do level because I'm doing for a home. Okay. Because home, and then I do click. So I'm coming back to the point. So this policy basically, as you can see, the person has paid 166,000 till 65. His income became 332. He has a protection of 500,000 from the day one. So he was paying 5,500 every year. So he paid this much total. Money became this. So now I have these policies options written here. So someone who has a house of $500,000, we can do 2 options. We can do $500,000 IUL complete, or we can do IUL of 250, and we can do term of 250 to 50 divide. Okay. Any questions here? Anyone has any questions? Okay, I'm guessing no questions. Okay. So what I'm trying to show, hello?
Hello.
We are good, Anil.
Yeah, we can hear you.
Okay. So what I'm trying to do here is, So this is a premium this guy is paying every year. And if we do for 250 premium, let's say someone says, man, Anil, I need money for my kids. I cannot afford. So I understand this is the money I will be doing monthly and I'm saving this much money. I understand and I'm lose money. I want you to help show me how this money which I'm losing, I will gain. So what I will do, I will say, look, sir, you are doing $1,000 saving. If you take a $5,000 IUL, which is 5,500 premium per year, your monthly approximately comes to 462. Okay, I wrote here, if IUL in full, 462, okay, divided by 12. So that premium, if you pay, hold on one second. What is 5, hold on, 5550 divided by 12 is how much? Yeah, 462, correct? Yeah, I'm correct. Okay. So 462. So basically, he's saving $596 every month. Every month he's saving that much money, correct? So that money which he's saving becomes $107,000. So $107,000 he saved in 15 years. I just did for 15 years, let's say. And on the other hand, he put total premium of 166, but the income became 332. So how much money he saved? 166. So 166 plus 107 total money he saved is 273. This is what basically I was trying to do. Any questions?
So you mean to say the mortgage instead of 30 years, if we go for 15 years, and that is what the amount which we are saving if we go for 30 years?
If you go for 30 years instead of 15 years, because in 15 years you're paying more mortgage.
Yes. So if we go, if we go for 30 years, you're saying that we could save 273K.
Yes. So 273K, basically the policy which I have designed, if you see, hold on one second. Oh, sorry. Where is it? Here. So 200 volts, the policy which I have designed is based on a 6.2. Okay. So 6.2 is the interest. So if you see this one, basically this policy I designed based on a 6.2%. Okay. So what I'm trying to say is, so usually remember I said in IUL policy you get a 0 to 10%, correct? So market can go 10, market can go 8, market can go 6, but on a 6.2 this is the money you are making. So that would basically I put number here. So bottom line is, now this guy who has a policy of $500,000 from the day one, he has a protection for medical, chronic, critical, terminal, cancer, and all is covered. I will show you the policy just to give me an idea. Hold on here. नहीं तो आप भी देख सकते हो, मैं कर रहा हूँ ना, ये आपके काम का ही है कुछ, ओके? ये एक्चुअली हाँ 7 मिनट चल रहा है काम है पॉलिसी, ओके? So look here. So basically here, see the protection we given to the homeowner for $500,000. Okay, he was buying a house of $500,000. So out of $500,000, this is a target premium. Okay, this is something an insurance company need. But if the homeowner says, you know what, Anil, I want to make more money, I want to put extra money. So this is a guideline premium. This is some coming from IRS. So IRS wants him to pay this much money. So if he put extra, the extra growth he will do. Remember, we were saving $1,000 every month when we did 15 years, 30 years to 15 years, right? So he had a capacity to pay $1,000. But let's say that someone says, you know what, I don't want to pay, I need money for anything. So in that case, if the money they save, so only basic, so he's still saving money. And now this money, let me show you what kind of protection he's getting. Look here, accelerated death benefit, plus you're getting all this chronic critical terminal, major heart attack, coronary artery bypass, stroke, invasive cancer, major organ transplantation, renal failure, paralysis, coma, severe, all this is covered. You got it? So now this home buyer.
To the tune of 500,000, right?
Yeah, up to 500,000, correct. So
Yes.
this coverage up to 500,000. So God forbid, if now the person, remember we talked about in the PowerPoint slide, which I was showing you. Now this family, who was basically two husband, wife, beautiful kids, house, home. Now they had all this responsibility. Now he has a medical coverage. Okay, all the terminology I said covered from the day one. He has a 386,000 worth of a coverage for a home insurance. No, not 300. Let me show you the policy again. Sorry, this one is. $500,000, right? $500,000 worth of a coverage he has from day one. So $500,000 worth of a home insurance protection he has. He has a educational. He want money for his education. He can take out. I show you again here. So let's say at the age of 35, he wants kids money for the kids' education. Or not kids, sorry, at the age of, let's say 50 or something. At the age of 50, he want money. So he has this much money saved. So he put 83,000, but he had that money tax-free available for his kids. So this is beauty because, so now there are 4 things he's getting. He's saving this money. He has extra cash of $100,000 because he's saving approximately $500-600. But if we do combo IUL and term, then he saves more money because then the premium goes less. And then he saves $146,000. I have put numbers here because the premium monthly is only $247. Every month he's saving $811. That's $146. But on a nutshell, the money also growing very less. He's putting 70, but money is growing only up to he's putting 88. His money is only going 159. So here he was putting 160. The money was going up to 332. Okay, any questions?
Yes, Anil, I have a question. Let's say he borrows money.
Hello?
Can you hear me? Can you hear me?
No, I cannot. Can you be louder, please?
Okay.
Yeah, I can hear you.
Okay, let's say a person withdraws 75K, that is eligible amount for his kids' college. So he has to put that money back to the account, right, at one point?
Okay, good question. So if there, there are 2 options because this is money. This is a zero interest loan. So if person is taking on money, so if we take out that much money, let's say for the college, right? So if we leave 10%, the policy will still run. I show you here. So let's say there are 3 numbers here. Let's say what age you are saying, 75?
No, let's say when he's at age 50, but he takes out some money, whatever the eligible amount, 94K for his kids' college.
Let's say at the age of 60, he wants to take out this money, okay? If he take out, he will need 10%. So money will, so if he take out 10%, whatever he will take out, that money will.
Anil, we are only seeing a blank screen with that graph. So.
Okay, hold on.
And I have a hard stop, so I need to jump on the other call, but you guys can continue.
Okay. So we will take 1 minute more thereby. So basically, let's say if you take out money here, money will show here. The balance of the money will grow again, but your death benefit will still stay same. It won't change.
Okay, I have one simple question.
Mm-hmm.
Hello, I am doing mortgage right now. A mortgage business right now. My question is, you told me 30-year fixed. You take the 30-year fixed. You pay low monthly payment. The same amount you can use the insurance. You can get more benefit. Correct?
Yes.
That's okay. Because 15-year you take a lot of principal amount, 30-year less principal amount, but monthly payment is very low. But
yes,
that amount, that difference amount, you can do the insurance, you can get a more very good benefit. Also, you can close your home shortly, correct?
Yes, because this money which you are saving here, right? This money you are doing saving because instead of doing 30 years, if you are doing 50, instead of 15 years, if you do 30-year mortgage, right? The money you are saving. So that money, you are not putting all the money, you are only putting $462. You see, That money is making that much money. So bottom line is you are getting now medical coverage for 30 years for life. You're getting a cash or tax-free benefit. And then best thing is this is non-declared fund. So, and you get the balance of the money, like this is available to you from the day one, you know, so you can use, so, and this is something similar to OPM, like others people money. You are not putting money today. And another thing is, this is very important because you are in mortgage, so you will understand, because for 15 years, the client will be able to use the mortgage to get tax deductions and interest deduction. Otherwise, if he pay early, he will lose that option also. So all of us, you know, remember I said like SALT deductions. So when you pay mortgage, there is a SALT deduction. SALT is local sales and local tax deduction. Okay, that's up to $10,000. So if you stretch your mortgage for 15 years, so for 15 years, you are saving another $10,000 worth of a tax refund for 50. So that's another $150,000 worth of a income you are making from a IRS, from government.
Okay.
Got it?
Yeah. Also one question. If you pay the difference, this money, the 400 something, the money you included good interest rate, also good interest also you'll give, correct?
Say one more time.
You know, if you are the difference 15 and 30 difference, some money is different money. If you put it on the insurance, we will get a good interest also.
Yeah. Because if you put the same money, if I put $1,000 extra every month, I show you one doctor. He's a very good client of mine. Look at the money, okay, he's making. And I don't know who asked me that question about HGI. Let me show you real quick and then we'll be done, okay? One quick question. So this is a doctor, okay? He bought $1 million house. So he was scared because doctors usually get like 44% lawsuits, as someone said. So now doctor is paying approximately $97,000 premium every year, okay? But he's so $94,000 premium every year he's paying, but his income at he only paid up to 45 till 45. So he's paid $1 million, okay? Because whatever he paid, IRS cannot claim it. Gone, it's gone. No lawsuit can take it. But his at the age of 45, if he want to take out, he can take out. But guess what? The money became at the age of 65. How much? He still paid million. It became $4 million. Now he has $6 million worth of protection. So he had a $1 million house. He had this much of money. So and then every year he can take out $400,000 tax free year after year. You get it?
Yeah.
All the way up to 85 and still has a death benefit of $1 million. Okay, sir.
I think 15 years is big benefit before the mortgage. Right now, this is benefit for me.
I know. Thank you, Joseph Bhai, for connecting. And, you know, I really appreciate you being in a mortgage industry. You will understand better. So everyone, please, you know, I will write down my number. If anyone has any question, please ping me or book appointment. My website is bit.ly.com/retire for free.
What we can
when
do.
I say retire for free, I mean it. I will show you how you can put $0 to retire for free. And especially for kids, anyone who's pregnant or lady, you guys will help them because a lot of Americans, they don't know. I every day get calls about place. My company, Villa, we are foreclosure experts. We do many foreclosures, you know, we used to be called Carrington. So then I started hating my company and luckily company changed the name from Carrington to Villa. So I still do flips, but you know, let's help one family a day. Okay. Okay, guys. Thank you so much. And anyone question?
Okay, thank you, Anil. We will have a separate conversation, maybe an interactive session with some of the people who have real estate knowledge. So thank you all for your time. And we will continue this series maybe Thursday or maybe next week. Too much of information. So we need to collate that. We need to go through that, let people come with a question so that they can understand and then have a follow-up session. Thank you so much, sir.
Thank you so much.
Thank you.
Thank you so much.